In this video, I'll talk about an important but often overlooked part of running a business, payroll pay cycles. The pay cycle you choose affects everything from employee satisfaction to legal compliance and administrative workload. We'll explore the most common pay cycles, the pros and cons of each, and why this decision matters for both employers and employees. Pay cycle is the frequency with which employees receive their paycheck. The most common types are daily, weekly, biweekly, semi-monthly, and monthly. And for employers, it is one of the most important initial decisions to make when hiring employees. It's more than just a schedule. It impacts employee satisfaction, cash flow, administrative costs, and compliance. There are other considerations as well. Employers must decide what pay cycle to use based on impacts on cash flow and payroll processing time. Sometimes the pay cycle is influenced by industry norms. If everyone in your industry is paying weekly, you may not be able to pay biweekly or semi-monthly. Employers also have to ensure that someone is available to run payroll and sign checks when needed. For employees, the pay cycle influences their family's budgeting and financial stability, but also affects savings, bill payments, and spending habits. Daily pay cycle is typical for gig workers or day labor, where the expectation isn't necessarily pay continuity. Weekly payroll cycles, meaning the worker is paid 52 weeks each year, are typical in hourly jobs and trades. The biweekly payroll cycle, where the employee is paid every other week or 26 times a year, is the most popular pay frequency in the United States. Semi-monthly payroll means that the employee is paid 24 times a year or twice a month. Salaried employees and employees in the finance sector are often paid semi-monthly. Education and government jobs pay monthly or 12 times per year. Each cycle has pros and cons. Let's walk through how pay is calculated under each. To arrive at the pay cycle, divide the annual wage or salary by the number of payroll cycles in the year. For instance, for daily payroll, divide $52,000 by 365, or for the biweekly payroll cycle, divide $52,000 by 26. Each of the pay cycles has advantages, like, for instance, the fast access to pay for the daily payroll, but also cons, like the high administrative costs. Employers can't just choose any cycle. You must meet legal minimums based on state rules. There are also additional rules regarding timely payment, final checks, overtime, and withholdings. This can be different from one state to the next. In addition, be aware that payroll must comply with the Fair Labor Standards Act. For instance, in California, non-exempt employees must be paid at least twice per month, whereas exempt employees must be paid monthly or more frequently. Final paychecks must be given immediately if the employee is terminated, within 72 hours if they quit. In New York, on the other hand, manual workers must be paid weekly, and for clerical and other workers, semi-monthly is acceptable. In Texas, final wages are due within 6 calendar days after discharge. When selecting a pay cycle, several factors come into play. First, consider your employee type. Hourly workers often prefer weekly or biweekly pay, while salaried employees may be fine with semi-monthly or monthly cycles. State laws are critical. For example, California requires at least twice a month pay, and New York mandates weekly pay for manual workers. Ignoring this can result in penalties. You'll also want to look at your payroll system. Some platforms charge more or become less efficient with frequent cycles. Administrative workload increases with more frequent pay runs too. And don't forget your employees' needs. More frequent pay helps with budgeting, especially for those living paycheck to paycheck. The goal is to find a balance between compliance, cost efficiency, and employee satisfaction.